Welcome to another MBS Highway live monthly webinar. I'm one of your hosts, Megan Anderson, along with Barry Habib. And today we are thrilled to welcome back Ivy Zelman. She's the Executive Vice President of Zelman and Associates. With over 30 years of experience in housing market analysis, Ivy is renowned for her bold insights and forecasts, including calling the top of the market in 2005 and the bottom of the market in 2012. Her expertise has earned her recognition as Barron's 100 most influential women in the U.S. in finance. Ivy's firm is known for its in-depth research across the housing spectrum, providing valuable guidance to industry professionals. So without further ado, join me in welcoming Ivy Zelman.
Hey, Ivy, it is great
Wow,
to
that's
have
quite a
you.
welcome. Can I
Great
take
to have you
Megan
here,
on the
Ivy.
phone? Thanks, Barry. It's
It's
great
great
to
to
be
have you,
on.
my dear friend. It's been way too long. We really appreciate that you're taking the time with us today.
Absolutely. Well, thank you. And I'm going to take Megan and take her on the road. Quite an introduction. Love it.
Gladly.
So, Ivy, you've been here with us before. We have a lot going on, obviously, with interest rates giving us a couple of teases, but being uncooperative. Hopefully, we could see some lower rates. We still are of the mindset that there is a good chance that we can see that still this year, where we get interest rates below 6.5. What we've noticed and what we've learned is that for the housing market to become more active, by examples of what happened in August, September, March, and early April, is that we really don't need 3%, 4%, or even 5%. It seems you get close to 6%, and the market seems to respond pretty well. Would you agree with that?
Well, you pointed out times when we got close and it did work, but it hadn't really worked with respect to helping the existing housing market too much. I think that it's really been stuck, as we know, with so many people locked in. 40% are still locked in below 3.5. But I'm more optimistic generally that we'll start to see more transactions as people's lives move on, and whether the three Ds, death, divorce, default, which I don't want default, but if the discretionary one has been on the sidelines, I don't know that it's just a rate decision. I think we need to stabilize the uncertainty in the economy. That is a big reason why people are pausing. But given that we've seen inventory rising, I think we'll start to see an increase in turnover. It might be that pricing's under pressure, but I think that would be healthy, frankly. Our home prices are up too much. Affordability is too stretched. So the dynamics are in position to see higher turnover, but pricing likely under pressure for markets where inventories are elevated the most.
Okay, so let's jump into inventory. We know that by our numbers that April to April, we're up 30% in inventory based upon active listings. However, when you look at pre-pandemic levels, we're still down 16% from pre-pandemic levels. Now, I know these are national numbers, of course, so we understand that. And we know that real estate's local, but we can't go to every single market, right? Um, but our population's also increased rather significantly, at least by 12 million, if you go by the stats, maybe more. So how are you feeling nationally first? And then are there any markets that you're either most concerned about or that you feel pretty good about?
Well, I think just looking at the inventory that you described nationally, it doesn't seem problematic. It's still very low relative to pre-COVID. But the markets that are very elevated relative to where they were pre-COVID, let's say 20, 40% higher, those markets in South Florida, Central Florida, Texas markets, that's where we're seeing pricing under pressure. And you can draw a line where there was, significant migration into those markets, second home, resort markets, really under pressure now. But you can draw a line where the production, new home builders operate, where they have been providing very competitive, value-added mortgage rate buydowns. They spec like crazy, thinking, to your point, rates would come down. Now we've got specs elevated back to 2009 levels, so they're going to move that inventory. So what's happening now is the existing market is competing with that new market, but where there isn't new homes available for sale, like the Midwest, which is a low concentrated market, home prices are still rising very rapidly, but turnover is still really stuck in those markets. So I think there's a balance. You want inventory so people have choice. And frankly, I don't know why the existing home sellers don't offer mortgage rate buydowns to their buyers, prospective buyers. I guess in changing the thought process, maybe instead of lowering the price, offer a mortgage rate buy down, a selling concession, that might work better. It's going to be challenging, but I think we need to clear the market and we need to see some healthy price reductions.
So it's such a good point that you bring up, and we've mentioned this as well. And we're speaking to, over 600 mortgage professionals that are some of the best mortgage professionals here. Clearly, what Ivy's suggesting here and what we've suggested in the past is do what the builders are doing. The
Yep.
builders have been successful in offering buy downs. So you can do the same exact thing with the seller footing the bill for it. Instead of offering a price concession, offer a buy down. And by the way, Ivy, just to mention this, everybody here already has access to it. We've got an incredible comparative tool within MBS Highway that shows you the difference between a seller concession or using a buy down. So you have it all at your fingertips, and it's working for builders, so it should work for your seller. Ivy, what markets? Well, regionally, to us, it still seems like the Northeast is still pretty darn solid. Are you seeing that as well?
Yes, I'd say, some marginal weakness now starting to set in on the move up. I think that relates to the uncertainties that we've seen in LA, Newport Beach. That also has now started to feel a little pain from people cautiously waiting on the sidelines, but generally healthier in those markets. Probably not the Northeast better than the West. The markets that we're concerned the most about would be Austin, San Antonio, South Florida markets, Denver. And similar to all of those markets, they have in common inventories are above where they were in COVID, more than 20%. And that's where pricing's been pressured. Where I am more optimistic, markets in the Midwest, Columbus, Cleveland, we've seen, whether you look at Kentucky, there's been continued pretty healthy activity. And again, I say that's where builders are relatively small in their presence, but there's still that offer of value that they've been able to provide to consumers. So, but the question, you go to Washington, D.C. as an example, and Washington, D.C. inventories are rising, but they're still below where they were pre-COVID. And yet the builders in that market are worried because they're rising very sharply, and we know what's going on with job losses there. So that might be a precursor of the markets that are going to start to feel some pain. And I don't know, renters are sitting on the sideline waiting. Rent turnover in apartments is probably the lowest it's ever been. So it's tough
You
out
know,
there.
it's so funny, Ivy, because I was going to bring up renters. I wanted to wait, and then you just, it was pretty scary because I'm thinking about it, and you said the word renters, so you freaked me out a little bit there. But I'm glad we're on the same wavelength. I am going to ask you about renters because that's important for us, because clearly that will be influential on some of the inflation reports we get. But before we get into renters, just to stay with the home buying market, a couple of times you mentioned South Florida. So I happen to be in South Florida now. Most of the time I'm here in South Florida. I guess like anything else, it depends on where. One of the things that I have noticed in South Florida is that both South Florida and Texas, in looking at the demographics, while the inventory levels are up, they have also seen the greatest levels of migration to those areas. In your opinion, does that mitigate some of the increase in inventory? Does it offset it to some degree?
Well, we've actually been following the migration patterns, and what we're seeing is both in Texas and Florida, a normalization. So we're seeing actually people departing from those states. We're going to be still elevated from where we were. Sorry, the dog is barking. But I think that generally speaking, a lot of people have been either not a lot, but there have been people leaving the market, whether they have to go back to work full time and they can no longer have a second home, or they're worried. I top tick the Naples market myself and bought in March of 24, met a bunch of people in the winter of 23. A lot of people just were selling because they're worried about sustaining the equity they earn and all the home price appreciation. They'll rent for a while, or they'll go inland and where they get better value, and they're selling at pretty attractive levels. So I think that, or someone says, the traffic stinks here, I'm going to go back to New York or Chicago and Detroit or wherever they came from. We are seeing that happening in some of the Texas and Florida markets, and you'll see that in the data.
Well, I'll confirm that during season, the traffic does get a little bit hairy here. So I've noticed that more this year than any other time in the past. And to your point, I'm going to ask you about a couple of other regions because I happen to notice that some people are asking. So I will ask you about that. But before I do, I did notice today there was a story that came out that said second homes had its slowest amount of transactions since 2018. So, do you think that that may be more reflective of economic pain? Do you think it's affordability pain? Because those people typically a little more insulated from affordability typically. Where do you think that pain's coming from in the second home market?
Well, I think that those that have listed their homes for sale, it might be that they're pruning their portfolio. Maybe they have several homes and the cost of ownership has not only gone up from the monthly payment, but think about the cost of homeowners insurance. Think about the cost of property taxes. We've had people anecdotally tell our realtors they're selling because they can't afford the property taxes or they can't get homeowners insurance. So I do think that those are having an impact. And by the way, it's not your primary residence and you can prune either your only second home or in fact several. It might be because of that higher cost of capital and overall expenses. I think there's a lot of uncertainty and people made a lot of money. And therefore, taking profits here, I think that's part of why we're seeing a lot of homes in those markets on the market.
So, Ivy, those are great points, by the way, and thank you. Ivy, when it comes to, you mentioned a couple of times pricing pressure. So that could be interpreted a lot of different ways. That could be, okay, I've listed it for this, and now I'm pulling back. But most importantly, not discussing median price, discussing actual appreciation. Are you seeing prices year over year to use, let's say, the Case Shiller methodology of same home year over year? So I believe
Mhm.
that methodology is most accurate.
Right.
Um, would you say that you're actually seeing true price declines? And if so, in those areas, what percentage are you seeing?
So the data that we have on, excuse me, local metropolitan markets show like mid-single digits declines for certain MSAs, like Austin comes to mind. I don't off the top of my head know what we're forecasting, but we are forecasting 25 to decelerate, but still be positive nationally. I look at the example of Cleveland, where I reside, and in 24, home prices were up 8% compared to national up 4. Goes back to the premise that that area doesn't have a lot of production home builders, not a lot of inventory in the market. There's still more demand than inventory available in that market, where that's why home prices are rising. I was in Denver.
And it's a little more affordable too.
Right, exactly. I was in Denver last week, speaking at a conference, and then also had a roundtable. We bring in mortgage and realtors and builders, and I couldn't believe how bad the market was there. And they kind of explained that builders spec there because the permitting takes so much longer than, let's say, Tampa, where you can get a permit in 4 weeks. In Denver markets, it might be 8 weeks. So they just build whole communities, and that obviously puts a lot more capital in the ground, and they have to move prices lower in order to move that inventory. So when we survey our proprietary builders, which account for about 20% of new home sales, that about 11% are actually reducing base price. Whereas in 25, we expect year over year declines nationally for the new home market. That would be net of incentives. And the incentives, it's going to be really interesting because since 22, when rates started moving higher, pretty much the industry did a great job prudently offering buy downs, but their gross margins were at elevated levels well
Higher.
above normal. And these are super expensive because they're buying the rate down for 30 years. It could be 800 basis points on margin. So I asked builders like in Denver, I'm like, what are you going to do? Because even the private builders are offering buy downs. If you're going to lose money on a house, how much further can you go down in margin? So I think they're hitting a wall, and it's going to be really interesting to see how that plays out. I'd say price is the lever, and they will move the inventory. That they're not going to sit on houses that have gone vertical.
So there's two areas that our viewers are asking if you would just chime in. Your thoughts on like the Intermountain West, like Idaho, Utah, Arizona would be one segment, and the Bay Area is another.
I would say that what we see in the Phoenix market is definitely pressure, probably more so there. It's a very high concentration of public builders there. Idaho, I haven't had an update on Idaho, but I did hear a lot of people leaving Idaho, going back to California. So outbound migration, which was hurting some of the sales or absorptions there. But no, nothing on Utah to give you. I could follow up, but I just don't know off the top of my head.
That's great. That's fair. How about the Bay Area?
It's funny you mention it because I'm actually headed out there June 7th. And someone said it's like spectacular. Like, and rents are really firming there and accelerating. And the city's the cleanest it's ever been. But I don't have any color on the Bay Area and how the housing market's doing.
Okay,
Sorry.
so Don't be sorry, Ivy.
I would tell you though, what we do weekly, for those that are not familiar with our research product, every Wednesday we have data on the Phoenix, Tucson, San Diego, Bay Area, LA, and I mentioned Phoenix and Vegas. And every Wednesday we aggregate data from the entire markets, and we saw the weakest absorptions for both Vegas, Phoenix, and California in the history of our survey for the last Wednesday. So when you look at absorption, builders would say for a community called a store, you want to sell one store a week, and that would allow you one sale for each store a week, and that would give you pricing power. So anything above one, you're seeing nice price action. But if it's below one, you'd likely start to see incentives. And it's been running in the
What do
0.75.
you mean? What do you mean store?
So we just think about it like a retail store, same store sale. You're looking at communities and think of them as a store. You want to sell at least one home per week in your community. So last week, the metro markets I mentioned were at the lowest ever from 20 years of tracking this. It was 0.59. And I know we're at the end of the selling season, but it was pretty disconcerting to see that weakness. And then that's when I picked up the phone and called a very large builder there and asked them. And they said, yeah, we're just starting to feel it in the last 30 days because they're a move up builder. So I wasn't surprised to hear him say that given the results of that Wednesday Western markets survey that we take.
Yeah, this definitely feels as if, and we do our own survey internally at MBS Highway, and in the last month we saw a very sharp decline. I mean, Megan, if you want to just even bring that up, if you have access to whenever you get a chance, no, don't rush it. We'll just do it when you get access to it, because I'd love for Ivy to take a peek at this. But Ivy, while we're looking at that, an important question is, as you mentioned, this amazing research that you do, which I'm a huge fan of. If
Thank you.
individuals that are listening would like to follow you, um, or purchase the data, what would be the best way to do it?
Just reach out to either Kim at Zelman Associates or Ivy at Zelman Associates. But we're always looking. My ex-husband used to say, "I'd love meeting new industry contacts more than jewelry," which wasn't true, but it was cute. And I would just say I would love to meet anyone who's interested in exchanging information. We wouldn't charge you if your organization's willing to fill out a mortgage survey or realtor survey, or you can purchase the data too. But it's good leading indicators. When we publish our home building survey monthly, we really have a good grasp on the market relative to the builders that represent over 50% of the new home market that they only report quarterly. So it gives us a leading look on what's going on in the market and all our other surveys too.
Any
And
thoughts
I
on Atlanta, Charlotte? Sorry, Megan. Any thoughts on Atlanta, Charlotte?
Charlotte's actually holding up really well from what I've heard. We just talked to a builder last week that has a large land banker there and also selling to builders, and the appetite seems to be pretty good. I hadn't heard anything yes or no on Atlanta, so I have to come back to
Gotcha. And you already mentioned the Northeast, like New Jersey, and everything was looks
relative.
pretty solid, but they're starting to show just a little bit of slowing, but still okay. And I think the key point here is that a deceleration is different than negative price action. So slower price appreciation, if you were to look broad based, of course, with pockets of weakness that need to be addressing. So um, let's talk if we can for a minute about the rental market, because that's one of the, Ivy, you guys are so talented there at Zelman Associates, and you have so much data. And I think what's wonderful is not only on the builder side, and I'm going to ask you about that, by the way, after this, and on the home value side and the price action side and the activity side, but you also have a very rich amount of data on rentals. And as I mentioned earlier, because it while there's tremendous lags, unfortunately, with the way that the BLS and BEA look at it, it's an enormous weighting of core CPI, 44+% of core CPI, and it's 19% of core PCE. So as a forward-looking barometer, what are you seeing rents? Let's start nationwide.
Definitely, we saw the bottom, the trough of rents in fourth quarter of 24, and first quarter was actually pretty strong. We started to see renewal rates going higher, with the exception of the Sun Belt, that we still have negative new move-in, and it's been actually surprisingly still a lot of absorption in those markets. So whereas absorption through the first quarter was at record levels, which is maybe a function of affordability for sale being so stretched. But we are seeing rents outside the Sun Belt reaccelerate, call it in the mid single digits, which is concerning to inflationary, hawks, because it will show up eventually. But the Sun Belt will keep the national numbers in the, call it 2% range. So you won't get back to trend line called 3 to 4 until 26. And by then, the backlog in the Sun Belt, a lot of it will be absorbed. And starts did pull back quite a bit in multifamily, although they picked back up in the last data point. They were over 420,000. So that's the optimism that there's a deficit of supply except for Sunbelt, and you better put money in the ground so that you'll have capacity when in fact, the market is starved for it.
So just to be clear, renewal rents is what we're talking about, first of all, right? So, and correct me if I'm wrong, I believe that makes up 53% of the rental market, with new rents being about 47%. I mean, maybe it's off slightly, but I think it's in that ballpark. So, for 53% of the market, if you remove the Sun Belt, you're saying kind of mid-single digits, but the Sun Belt would then take the overall national weighting down to potentially below 3% on renewals. Does that make sense?
Yeah, actually blended. We're
Blended.
blended rent growth, including new move-in.
Okay, including new
Yeah.
first-time rents, right?
Right.
Okay, now I'm with you.
Yeah.
So from an inflation standpoint, if you're looking at a number south of 3%, right, and you said maybe even 2.5%, right, on a blended new renewal nationwide number, that is still significantly, the real number is still significantly below the numbers we get from the BLS and the BEA, which I believe the most recent number is like 3.9%. So you're talking about, let's round it off and say 1.5%. 1.5%, 40% of that, that's 0.6 of the inflation number.
Right.
If the Fed were looking at this, we'd be at their 2% target, right? I mean, we'd be right where they want to be, and they're so restrictive right now. So I just wish there were a way that the Fed could get their numbers from you, Ivy, instead of the BLS or the BEA.
Well, remember when we were going the other side, when it was transitory, and we're like, wait, rents are going nuts. It was so obvious, but I got tired of fighting that trend and recognize that the Fed's way
Oh,
behind.
we were screaming the same things, Ivy. We were screaming the same things that they should be looking at. And they missed the ball on that, and unfortunately they're missing it again. But it's crazy. I don't mean to get on the soapbox here. They do have the potential to use critical thinking when it suits them. For example, we got a number on GDP, which was a negative number. But they said, instead of taking it face value like they do with the rent numbers and like they do with the CPI and PCE, they said, hold on a second, that's the rent, the GDP calculation is exports minus imports, and there was an exorbitant amount of imports front running tariffs. So let's throw that out. But yet you get a job number.
Right.
Well, let's not talk about all of the revisions that were negative. Not even the QCW, which was still going to revise it lower. Not even the birth death model, which is just a total bullshit number. That they take at face value. Or
Sure.
when it comes to the inflation numbers, not to mention that the rents would catch up because the real time numbers are less. So when it suits them, they could be critical thinkers, but otherwise they're just, and they're all a bunch of lemmings. They all just jump in the pond together and just follow each other, because unfortunately at our Fed, you get ostracized if you disagree. You compare that to the UK, where you have a beautiful disagreement, 5 votes versus 4. Now you have people like actually conversing and thinking. But I'll get off the soapbox. I'm just pissed at the Fed.
I love it. I love when you get fired up. It's great.
So a couple of quick ones here. Hawaii, Sacramento, any thoughts? I'm looking at these as they come in.
Sacramento is one of the markets that we cover. I should have mentioned it in the Western markets data, and definitely weak in Sacramento. So I'd say that's been more of a starter market, tends to be first-time buyer market, and there's a lot of production builders there.
You have thoughts on the next 12 months for a number that would be a reasonable pencil it in for nationwide appreciation over the next 12 months?
I think we were at 3.5% nationwide. I'd have to double check that, but we're definitely seeing deceleration, but the magnitude is not as severe, given that, again, we've got a very diverted or divided marketplace where inventories are the catalyst.
Yeah, we just updated our 12-month numbers as well. We're at 3.9%. So you and I are very, very much seeing things similarly on a nationwide basis. always a good place to be when I'm agreeing with you, Ivy. So, it's
Right.
good.
We're a little concerned about seeing some early stage delinquency numbers moving up. Nothing yet to be alarmed about. But FHA got pretty easy post-COVID when the market slowed with back-end ratios over 11% or above a 50 back-end ratio. And we're seeing early stage delinquencies going delinquent faster and at higher levels. And the same thing with the 24 vintage. I just think people are really stretched, and a lot of people probably got in over their heads. So we'll be watching that closely.
You seeing first time payment misses or no?
I have to go into the data and look
I
at
got
it.
you. That's usually the big red flag. It's first time payment miss. I mean, that's like the big one.
There
That's
is a really significant increase in bad debt expense for renters in more of this BC asset class, but not so much in A's. But I was hearing a lot about that in Denver. Problematic.
Ivy, we've said that even though you take the Fed claiming that the economy's solid, this and that, the data that we look at would really tend to suggest that it is not necessarily solid. I'm not saying it's bad and it's horrible, but we are definitely seeing some stress points here. We believe that it's the top 10% of income earners that are accounting for about 60% of the economic activity out there. And those that are on margin, it seems to us, by the increase in buy now, pay later, the increase in delinquencies. Now, maybe buy now, pay later could be a little misleading because it could actually at times be a better choice than a credit card. So maybe it's just strategic as opposed to desperation. But certainly the amount of delinquencies speaks to people being in trouble. Are you seeing something similar to that? What is like? Maybe it's not hard data that we're seeing, but is your gut tell you that maybe this economy and individuals are having a harder time right now? By the way, Ivy, I just, I ask myself this all the time. I'll go shopping, we'll go out, and I'll say, it's so freaking expensive.
Right.
How do people manage this? Because not everybody's making $200,000, $300,000 a year. How do families manage this? And they see people everywhere. Doesn't look like they're all $300,000 or $400,000 income earners. I could be
Right.
fooled. But yet I ask myself, how are they doing this? Going out to dinners, it's so freaking expensive.
Yeah, I would just say that, talking to some banks that have significant retail exposure, their only problem is subprime. That's where they're seeing the problem. So it's really the people that are the lowest earners that are seeing the most challenges, which makes total sense. My 24-year-old is making $20 an hour as a clerk at a law firm downtown Cleveland. And if I have to supplement her, I mean, there's no way that she can live off of that. So I think that fortunately, whether boomers, Xers are supplementing their millennial Gen Zs, but I guess they're lucky that we have those cohorts that have money that can help out, whether it's buying absolute, homes for cash. We're not seeing that as much anymore, but we had seen that, during COVID. But yeah, it's really tough out there.
Yeah,
I
yeah,
don't
I think
for young
so.
people today, it's, how do you rent an apartment? How do you buy a house?
Ivy, you have been known as flat out the best uh, analyst for builders, flat out.
Thank
Do you have any builder stocks that you like, that you would be cautious of in the current environment?
Yeah, I would say right now, I do think the home builders are probably the best position they've ever been in prior to any type of downturn, assuming, we don't have a soft landing. But because of where the valuation of the stocks are today, if you have a 12-month investment horizon, I'd probably be more patient because their gross margins are definitely going to be under pressure. The spring selling season's been a bust. It's not yet really reflected in their stocks, but I do think there's some very high quality companies that we're recommending, but we're more neutral on the actual sector. And then you say, well, if you don't like the sector, which ones, if you had to buy, would you want to buy? So we like Pulte, Toll, Lennar, Meritage, just to name a few. It's just about, timing. And the stocks did get pounded pretty badly, but they've rallied back sharply with the market. They face tariffs. I mean, it's interesting because we do a building product survey that's north of 250 billion in revenue, and we just published it today. And as you said, there was a lot of imports that were, trying to get ahead of tariffs, but they're having a hard time passing price increases to builders because the builders are pushing back and say, I want to know exactly where your pain point is. Show me where the tariffs hit your P&L. And a lot of times it's crickets after that, but they're not taking price increases easily.
That's good that we're getting pushback from the builders. They're smart, and they realize, and one of the things we teach is that just to use an example that we give, people, tariffs are very misunderstood. And the public doesn't understand it. Oh, you put a tariff against Vietnam. Oh, why are you going to hit Vietnam? Vietnam doesn't pay it. The importer here in the U.S. pays it. But if it's a $10 T-shirt and it's a 10% tariff, that's $1 is the tariff. Now, that's going to get marked up to the wholesaler, marked up to the retailer, and then probably doubled price to the consumer. So that T-shirt that's selling for $39, it would have sold for $38 had it not been for the tariff. And that's my point, that most people just think, oh, that means everything's going up. Now, a vehicle that's imported, that's going to be a different story. If everything all in is imported, take away the profit margin, and then you have a larger percentage, of course. But it's never going to be quite the amount of the tariff, because that's only the difference that the importer pays. And then there's absorption. We're seeing a lot of absorption, not just from the home builders, but across the board. It appears, at least initially, there is some hesitancy to go ahead, because they're afraid that they're going to lose the sale. They're afraid that people are going to, and consumers are just going to say no. And
Well, I had a builder tell me that they were going to switch their plumbing contract because they're not taking a price increase, and it's a pretty big contract. So they're really going to potentially risk, cutting their nose, or cut your nose, spite your face. But it looks like there's real risk for some of the manufacturers that are pushing hard on price.
yeah, and I think that's, getting back to the Fed for a minute here, I think that's something that the Fed has blinders to as well, is that, very few of them, if any, have any real world experience, and they don't understand that there is going to be pushback, there is going to be negotiation, there is going to be absorption. They just, unfortunately, the way that they look at it, from a very restrictive stance currently, by the way, for about 100 basis points restrictive, that they're just not trying to be forward looking whatsoever. Ivy, you did mention some of the builders that you like, and you did mention that builders currently are in the best position that they've been in. What do you see as far as, if you were to say, across the board, a rate that would create, is there a magic rate in your opinion? I told you where we think it kind of is, but what do you think, as far as, we're not that far off. If we're around, let's just pick a round number and say we're around 7% right now. Do you think if we get to 6.5% or 6 3/8 or 6 1/4, that things really change as far as activity and price?
I just think of the builders today that are offering consumers 4.99, 30-year fixed, and they're still having trouble right now, Barry, selling houses. So I don't think this is just a rate discussion. Yes, rates will play, top three in the decision making, but first comes confidence, and certainly the consumer's been sort of rattled. And then you add jobs. If you're worried about your job, you're not buying a house. It doesn't matter what the rate is. So I just have been watching the slowdown in the new home market despite those absolute levels. And I'll ask a builder, we'll get a rally in the 10-year, and we can talk about the 10-year, 30-year spread. But hey, did you see a pickup? Yields are down 50 basis points, and the answer will be, well, no, because we're already offering lower rates. So we haven't seen the, sort of pick up when rates have come back down. So I think it's a bigger picture. More people are just more cautious, and they're in, wait and see what happens mode. Understandable with what the volatility of the market, all the noise from the administration. I think that there's more hesitancy than there had been.
You bring up an excellent point, and it makes very good common sense that, hey, we're still having a little tough time moving product, and we're offering 5%. But a couple of things there. At least from what I see, the new home market is, for the most part, significantly more expensive than much of the existing home market. So perhaps it might make a difference on the existing, or maybe it doesn't. But and the other thing
I do
is that,
think if the existing market started offering seller concessions, there certainly buyers are not getting offered a 30-year fixed at 4.99. And I just don't understand, to your point, why don't they do more of it? But I do think that would be, even if it was 100 basis point lower, there would be buyers that have been looking on the sidelines. And interestingly, median new home is actually on par with existing median price today. So it's really been that continued value proposition that they're trying to compete against existing home using those mortgage rate buy downs. So maybe we'll see more of that. But the purchase mortgage originations have been improving despite the fact that we're seeing slowing in new construction. So I think that inventory is helping to loosen up the market a little bit. Not as
Yeah,
much.
and just to give everybody a math equation here, because if you don't know this, and you should, let's just round numbers. Take an 80 LTV, so your buy down cost is not going to be the purchase price; it's 80% of the purchase price.
Right.
And if you wanted to bring it down, let's 3/4, 1% in interest rate, it's typically going to be about 300, 400 basis points in points. So what amounts to somewhere between a 2.5% and 3% price reduction, you can actually advertise that home for 3/4 to 1% below market. So maybe there's a way to get creative and offer 5.99 and talk to the real estate agent, talk to the seller, and say, hey guys, let's do this. Let's hold firm on the price,
Right.
but let's offer 5.99 instead of saying, hey, I know I got 3 or 4% of play here in the price. Let's hold firm, offer 5.99, 30-year fixed. And now you may have a lot more activity. Well, you certainly have something to market to, right?
Right. It's definitely a tool in your toolbox that others aren't utilizing. So I think the realtors should try it, and I think it's a combination where I've been told when I'm in for a tough discussion that we need to do a price reduction, maybe offer it in lieu of that as another opportunity instead of cutting the price. That's kind of the way the realtor community has been thinking through it.
Yeah. Yeah, I agree. I agree. That seems like a pretty simple option there that should be considered. You know,
Yep. It's a
I
little
think,
more complicated. It's not so simple. So I think utilizing it would give them a competitive advantage versus other homes that are on the market.
yes.
Hopefully it would
Yes.
help.
Um, Megan, are you seeing anything there that are that we should be addressing with Ivy? We've got one of the best minds in the world here.
It's so
Well,
sweet.
I
One
have
of
a
my favorite
question.
people.
Right now we just got done talking about all the economic uncertainty that is out there, and mostly everyone on this call is either real estate agents or loan originators. And you kind of have this forecast of what you're forecasting into the future with the housing market, and you have a very solid look at it with all the data points that you have. For all the originators and agents that are on here right now, when they're getting asked those tough questions from the consumer, is it a good time to buy? I mean, what would you maybe advise them to say?
Well, I get that question from consumers too, just because of what I do for a living. And my answer is, do you have to move? And questioning their position. Think about rent. You rent an apartment and you spend, call it 3,000 a month or 36,000 a year. You'll never see that 36,000 again. So if you're buying a 300,000, $400,000 home and maybe you pay 10% more than where the market ultimately settles, that's a year's worth of rent. So I just tell, do you have to move? Is this just a life, style decision? You're having your family's getting bigger. So that's my first question normally. And then I'll say, there's going to be deals out there. I have a friend in Naples who sold and she's renting now because she felt like she wanted to lock up a lot of the equity that she earned. And she's just waiting. And I said, you got to be in the market, you got to be looking, got to be working with a realtor, get pre-approved because there might be a divorce, a death in someone's family, and they're just going to blow it out. So I'd be opportunistic, but I also would say buy it. And, home prices going down 10 is a pretty significant decline. And I would think that, if you think about it in the sense that I just provided the rent comparison to ownership, I think you're still better off buying down, assuming a 10% deflation is your worst case. I'd still buy there than throwing the money away in a rental.
Yeah. Ivy, this has been very enlightening in so many ways, and I think that people that are listening are getting great insights and hopefully some great ideas. Um, is there is there a is there an outlook that you have? Let's just say many people buy their homes, and I think 10 years is a pretty reasonable expectation that many people stay in their homes.
Right.
So, I know that, we look at changes in price year over year and things of that nature, but it's almost unrealistic to do so because the only time the price really matters is when you're selling it, right? I mean, it just, it's kind of like, so if someone were to buy today and again, let's just say 10 years from now, The numbers that we often look at is household formations. Now, we've averaged 1.8 million household formations per year for the last 5 years. And we try to look at demographics, and we look at baby boomers and Gen Xers, and we think their home ownership rates maybe flip flop over the next 10 years, but they'll kind of cancel each other out. But we do see a lot of growth in household formation and home ownership in the Gen X and the Gen Z models, the millennials and the Gen Z models. We think over the next 10 years that'll grow. Do you feel that that will put a good amount of support over the next 10 years in home prices and support them so that you can see pretty good 10 years from now appreciation in your home?
Well, assuming we saw a reset, I'd feel a lot more comfortable clearing price where the market stabilizes, but I am less optimistic on household formations than you are.
Okay.
I think that affordability is going to keep young adults at home longer. During COVID, the first year, 20 and 21, we had ending 2020, according to the Census Bureau, and we used generational, so 20 to 39-year-olds that were living with their parents ended 2020 at 24%. By the end of 22, it declined to 21%. And that's compared to when I was growing up, like 15%. So what's happened is young people are staying home longer. And, I joke it's because we make it too comfortable for them. They have kick-ass rooms. They don't need to leave. They live in their parents' nice homes, but they really can't afford it. And it's okay to live with your parents longer, maybe save money. They call the boomers the sandwich generation. They're sandwiched between their aging parents and their, millennial Gen X, Gen Z family members. But, think about Europe and multi-generational living. So with death rates accelerating, birth rates under pressure, and now immigration under pressure, I'm less optimistic that we have a good window to justifying the need for more shelter given the household pressures we're seeing. You still need starts, but you won't need as much in the backdrop we have relative to history.
So, and you bring up all good points, but let's remember I'm talking about 10 years. So, I mean, maybe that, 27-year-old is living at home because they're living there longer, but will they still be there at 37 is my point. And eventually, will they move out from mommy and daddy or get their own place? And at some point in time, I don't think that the world has changed that much. I think there might be delays. People are waiting longer to get married, longer to have kids, but it's going to be a little tough to be married with children and still with mom and dad,
Sure.
So what I'm trying to say is over the next 10 years, will we see those formations then outweigh the number of starts, which currently, at least from our side of things, and we like starts better than permits because even though a permit you don't got to build, a start, most of them are going to go right. So it appears that we're only doing about 1.3 million, maybe somewhere on average 1.45. I know the latest was like 1.3, but maybe it ramps up. But Ivy, isn't that a big ship to turn? If you really wanted to ramp up starts, it's not like Genie and you blink. It takes a while to get that cruise ship turned around, right?
Well, it's interesting. We've gone back and looked with 30 years of data, and with the constraints now more prevalent, really post GFC, it's very difficult for starts to grow more than 10%. Something breaks when it grows more than 10. Supply chain issues become prevalent, acquiring enough lots on the ground. Land has been inflating without any abatement. We're seeing a little bit of deceleration in land inflation right now, but I think the builders are going to have a tough time. Right now, starts are down about 9% for single family. Year over year, the April data showed down 12, but our survey, our proprietary survey, is showing it down 9. And keep in mind, orders are way below starts. So you are right now with too much inventory in the market that needs to be cleared. And builders are going to be cautious. So we see a decline in builders' interest in buying lots right now. Still buying, but they're definitely decelerating in how much they want to acquire today, whether it be on balance sheet or off balance sheet. So I'd say 10% is the limit on how fast, at least in single family, they can grow.
So that does support the case that over time, over the next 10 years, what I'm trying to say here is if you're listening here as a mortgage professional and you're talking with your customer and maybe there's some trepidation as to value, if they're going to be there for 10 years, there's reason to believe that demographics over that time can be favorable while supply would be difficult to
Right.
accelerate to the point where it's going to be just a glut. Obviously,
You're
caveat
selling
is
to a consumer, the best sales pitch is, if you're renting versus owning, if you want to move up, it's a different, discussion. But the only way really call it, white collar workers create wealth and maybe blue collars invest in the stock market, but it's usually their home that creates real wealth for them. And that's, 10, 20, 30 years. And people that look back and say, wow, I should have bought, or, my kids, the only thing I have for my kids today is the house that now I have no mortgage on. So I say you convince them to buy because you're throwing money away to rent and you'll never create wealth. I looked at some data that was disconcerting. How many renters today are spending more than 30% of their income on their rent payment? And the answer is 52%. How
wow.
many consumers that own their home today are spending more than 30% on their monthly payment? And it's 23%. Because that homeowner got in at a better time, maybe, but the benefits of home appreciation give them a lot more cush because they know they have that support. So I say you got to convince people to step up if they can afford it and not worry about where the price is.
And the benefit of locking in a good portion of that payment, clearly taxes could go up, insurance can go up, but a good portion of that payment of now stopping the acceleration that you would normally have had with a rent.
Right.
What percent of the action right now is new construction versus existing?
15. It troughed at 11, and historically, trend line's been about 15. But
Yeah.
for the 400 basis points of growth the builders regained, it was really given this stuck factor in the existing home market. Now that's starting to loosen up. In fact, some clients of ours think maybe higher rates are better. Sorry. Hey, can someone get my dog? Sorry. Higher rates are better because then the existing market stays stuck and builders will have an advantage. So there are clients that want rates to stay up for the builders, and I don't necessarily agree with that, but I think higher rates are bad for everybody because affordability is so stretched. But nevertheless, they're definitely at the risk of losing share right now, I think.
Yeah, there is a downside to lower rates for those that are savers, which brings me to my next point is that, and by the way, just to give you peace of mind, we don't hear the dog. So I know you hear it, but we don't hear it
Oh,
coming.
okay, you don't? Okay, sorry.
Um, the the fact that 39% of the market does not have a mortgage and that there is significant equity amongst those who do,
Right.
um, in your mind, how much of a role we think it plays a major role in home price stability because those people don't care about higher rates. Um, how much in your mind does that play a role in being supportive of home prices? Because as those people move, they're not worried necessarily about affordability and about mortgage. And it's so significant. It's practically 40% of the marketplace.
It's always been though, so high, it's been a high number, 35, 40 for at least.
If I'm not mistaken, the stats that I looked at was 32% 10 years ago. So it seems to have made a big increase.
Okay, maybe I haven't looked at it lately, but it's a good thing, right? You've got people that have substantial buying power if they want to sell, so it can't do anything but be a positive for the market.
Ivy, I can't believe how fast time goes every time I talk to you. When we're on the phone, I take a look down. I'm like, holy shit, we've been chatting for an hour, and no different
Well, I
this.
learned so much from you. You want to tell me why the mortgage spreads are so elevated still?
Well, you know what? The mortgage spreads, there's a lot that has to do with some of the reason why the mortgage spreads are elevated. Interestingly enough, I did have a meaningful conversation with Scott Besson.
Oh, good.
And he did think, and by the way, please don't think I'm getting political here, but he is one of the most keenly aware the most keenly aware Treasury Secretary that I've seen as far as understanding the housing market, wanting to unfreeze it, understanding mortgage
Private
spreads,
sector.
and in addition to that, things that he wants to do, issuance. But he feels that the bank deregulation deal that they're working very hard to do will accomplish a couple of goals. It'll make it easier for banks to hold treasuries, which should bring rates down. But he also thinks that that'll play a major role in reducing the spread, and it's a big goal of his. Now, he did share with me that his target for the 10-year treasury is 3.9%. So you bring such a good point up, Ivy, because if we're at like 2.5, 2.6 right now, the spread between 10-year treasuries and 30-year fixed rate mortgages, and I haven't looked to see the exact number, but it's in that range. And the normal spread that we were very well contained was 1.6 to 2%. We could pull up a chart and show you it's perfectly there between 1.6 and 2. I don't know if we get there, but maybe he accomplishes the goal in getting us halfway there. Maybe we get to 2.25. And if Treasury Secretary Benson is right, and we
Right.
get to 3.9, and he's doing everything he can, he's terming down, meaning more issuance of short term, less long term. These are all things that they want to do.
Yeah.
That brings you to around 6.125 on a 30-year fixed rate mortgage. Do we get there? Remains to be seen. But I do think that's kind of a reasonable target. And he does.
The route that you're referring to, whether it be bank deregulation or whatever strategy they may have, that's a good thing. As long as we don't get to 3.9 because they break the economy with whatever their latest legislation is offering. But I think that would be great if they can get that spread down. It would certainly help.
Yeah, and mortgage spread, somebody's suggesting that's simply the spread between 10-year Treasury and what a 30-year fixed rate mortgage is offered at. That's that spread.
Really the output of the secondary mortgage market and what's happening there.
Yes. And historically, it's been 1.6 to 2. Then COVID came, it went way up, way down, and then way, way, way up in October 2023. It was over 3%.
It was 3.5.
Yeah, it's been coming down.
Right.
But as confidence grows, another thing too is servicing values as they come back. That will add more value to a mortgage and narrow the spread a little bit more too. Megan, anything else before we wrap here?
Well, everybody loves the dog, so no need to worry about that. Ivy, I want to thank you for your time here today, and thank you to everyone that joined the call. I did put Kim's email in the chat box. If you guys have any questions, you're interested in taking a look at Ivy's research, please reach out to that email that I put in the chat box. And with that, Barry, I'll let you close it out.
No, Ivy, we appreciate you very much. It's really nice of you to take your very valuable time. Everybody tugs at you and wants you, and we feel special that you allow us to share your genius with our team.
Oh my God, you're so funny. But thank you. Anytime, Barry. Love being on with you guys. And I'm looking at the hearts floating up. I love it.
Oh, we all love you, Ivy. We do.
All right, guys. Have a great.
You look great, by the way, Ivy.
Thank you. I have a runny nose. I'm trying to.
We can't tell. It's all good.
All right, guys. Take care.
Bye. Thanks, Ivy.
Bye, everyone.